Hello, best of your listeners, and welcome to the best real estate investing advice ever show. I'm Theo Hicks, and I'm back with Travis Watts for another edition of the Actively Passive Investing Show. Travis, how you doing today?
Theo, doing great. As always, happy to be here.
Yeah, thanks for joining us. And today, as you can see if you're watching on YouTube from Travis's background, how to invest like a pro, speculating versus investing. So I think this is gonna be a very good topic. Um, it's simple, but it's very it's very important to understand the difference between speculating when you're investing and then actually investing. So, Travis, maybe again as usual, tell us kind of the background to why you wrote, because this is gonna be based off of a blog post Travis wrote, and then we will dive into the differences between speculating and investing.
Yeah, to your point, Theo, it's a basic concept. It may not even warrant a blog post. I did it as a blog post because I felt it was important enough to share this with people, and because I have so many conversations with investors week to week, and oh my goodness, the term investing is just not created equal, especially in the real estate space. It gets thrown around loosely, but I don't think a lot of people have a good grasp of what it even means to be an investor. And so I really wanted to hone down and clarify, even though a lot of these listeners probably, if you're listening, you probably think you understand already, and maybe you do, but I want to break it down a little more in depth to paint some real examples of speculating versus investing. So that's kind of why I wrote it and what we're going to talk about. So.
Perfect. Yeah. And so if best of your listeners, if you're a loyal listener, you've been listening for a while, you know that Joe has his 3 immutable laws of real estate investing. And the first law is to buy for cash flow, not for appreciation. And the distinctions made between natural appreciation and forced appreciation. So that law of real estate investing is going to apply to what we talk about today.
Yep, 100%. It goes hand in hand. So lesson number 1 I put in the blog is about the velocity of capital, which is something not widely talked about. And the velocity of capital is just this simple concept that your money has to continually be moving. You have to be constantly reinvesting, reallocating, doing a refinance, having a sale, moving money around. The minute that you start taking cash and shoving it under a mattress or putting it in a safe, putting it in the bank, it begins to die. It begins to die not only because of inflation, but potential loss. And when you're locking a bunch of home equity in, let's say a stagnant market, all that cash is just sitting there locked up, and there's nothing you can do about it in order to access it. So so you could think of it like, I think I put this in the blog, like electricity. So electricity, electrical current has to constantly be moving. The second that it stops moving, it starts to dissipate, erode, and go away and die. Well, that's the same with your money. So think about it that way. So couple things I wanted to define up front is what is speculation, what is investing. Let's just give some simple bullet points here. And by the way, there's a lot of ways to invest, and I'm not advocating one is better than the other. I just want to paint a scenario and let you set with that to think if maybe that could apply to you. I've made money. Theo's made money. A lot of people have made money in the speculation space and in the long-term approach. So speculation is like, okay, let's say that you're going to flip a house. Why is that speculation and not investing? Well, you're speculating that your rehab budget is going to cost what it's going to cost. You're speculating that it's going to take you about 3 months to turn that property over. You're speculating it's going to sit on the market 1 month after that. You're speculating the purchase price someone is going to be willing to pay for that. That's a lot of speculation, and that's why it's not investing. You have to constantly be repeating that process and gambling in a sense on a lot. It's an educated guess, hopefully, but it's still speculating. Another example, I hear this a lot on the real estate guys. I'm a big fan of their podcast, but they have callers that call in and they'll say something like, hey, I bought this property out in California and it has a negative cash flow, or it's a break even, it doesn't have any cash flow to it, I'm renting it long term, but hey, it's in California, it's an appreciation market, right? So like in 5 years, hopefully I'm going to sell it for twice what I paid for it. You know, that again, you're speculating the market's just going to go up, up, up and away forever. Look at what's happening to California right now. That may not be the case. So there's an element of speculation to that without having any cash flow. And a development deal, whether syndication or your own, you're speculating the cost and the build and the time frame and the permits and what it's going to sell for, what it's going to rent at. There's a lot of speculation in that. So, you know, of course, you don't have to agree with me on this point, anybody listening, but I see these things as, you know, speculative, you know, opportunistic types of plays and less about investing. So let's talk about investing. What do I mean then? Who's an investor then? Well, cash flowing real estate. I mean, primarily, because what are you banking on? You're banking on the current income. You're actually buying an income stream. You know, you actually have tenants in there right now. You have a long history of people paying and what the collections have been. And so that's what you're really banking on. So it's still a little bit of speculation. That would be the speculation that people are going to continue renting your property over the next few years. You know, that's your speculation, but it's a lot more conservative than thinking you're going to lease up a 400 unit building from scratch in 12 months. You may or may not. A dividend paying stock. You know, a lot of people buy stocks because of their dividend, because they've had a consistent distribution of dividends for 20 years, let's say. So, you know, that's an investor. You're investing for cash flow, or same with like a bond, right? I mean, most people aren't buying bonds because they think it's going to go up in value. They're buying it because of the yield on the bond. Bad example in today's world, but historically speaking, you know, you can get 5, 6, 7% on a bond. That would be the case. So any thoughts before I move on, Theo, from that?
Yeah, so I'm glad you made that. You kind of made that distinction at the end and said that, you know, really, like if you're in buying for cash flow, there's still some small level of speculation, but it's minor compared to some of the other investment strategies where most, if not all, of the moving parts are based off of, you know, speculative assumptions, assuming that things will continue to go the way that they go. And this reminds me of something that we're putting in our passive investing book that's be coming out in early 2021. And it makes the distinction between, it's talking about relating to risk in different investments, and the possibility, basically possibility versus probability. And so no matter what you're investing in, there's always a possibility that something goes wrong. Right? There's no investment that's 100% guaranteed to be to perform exactly how you expect it to perform. Now, again, right? So it's possible that won't happen for all investments. So the question isn't, well, is it possible to lose money? Yeah, obviously. The question is, what is the probability of you losing money on that investment? And so the more assumptions that are put into this deal, the more likely or the more probable it is that money will be lost. And that usually, again, it's not always the case, but usually the more probable it is that you lose your money, the also more probable it is that you make a lot of money. So when it comes down to speculation versus investing, when you're speculating, the probability of you losing money is a lot higher because of the number of assumptions that are made, as opposed to when you're investing. Sure, you're still making money. Sure, it's still possible that you lose money, but the probability of losing money is much lower.
That's a great point. I appreciate you pointing that out. That's 100% the case. Yes, couldn't agree more on that. So I point out a couple of things. I say that, you know, professional real estate investors understand two things. Number one is the need to continually move money into new investments. And number two, how cash flow is used to create exponential wealth. So let's talk a little bit about that. I put in the blog an example of a gambler. So just to paint the picture of a term that I used in the blog called house money. So if I go to a casino and I have $1,000 and I go place $1,000 bet and I end up winning $1,500. Okay, that means I now have $500 more than I started with. Still have the 1,000 plus the 5. So if I take the original 1,000 that I had first bet, that I won back essentially, and I put that in my pocket, and now I only have 500 left in my hand, now I'm playing with house money. I mean, what is my risk at this point, right? I can go around and just bet here and there, $100, $100. I can go to zero, but ultimately I didn't lose anything, right? Because I still have the $1,000 I walked in the door with. So you can play this game without being a gambler in terms of being a real estate investor, a cash flow real estate investor. So the example I lay out in the blog is if you had, just for example's sake, $500,000 and you decide to spread your risk into 5 different investments, 100K, 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 100K. Let's assume each of those cash flowing pieces of real estate give you a 10% annualized return. Okay. So that means at the end of the year, you're going to have $50,000 in passive income, right? In collections and dividends or interest, you know, if you want to relate it to other assets. So here's the thing. At the end of that year, let's say it's December now, and now I have 50,000 more than I started with. I can take that 50 and go make a new investment. I can go put 50 into a syndication or private placement or some stocks or whatever. And I'm now playing with house money. I now reduced my risk because now I'm going to go leverage and make even more cash flow and have even more tax advantages, but not have to be worried about that 50,000. And every single year, assuming these are multi-year deals, you can do the same thing. Every year you get to take another 50 and put it, and actually it'd be a little higher because you're compounding the, you know, the earnings on the new investment as well, the 6th investment. And so every year, you know, you play with more and more house money to the point that you're playing mostly with house money. And so you're therefore reducing your risk as compared to, now let's look at the opposite situation. I have $500,000 to invest and I spread that into 5 development deals that are going to take multiple years to develop. Well, that means A, there's probably no cash flow in the meantime. And what happens if in 3 years down the road, the market shifts? We go into a great, huge recession. And now our assumptions, our speculation, they're way off. We're never going to sell this property for what we thought. It's costing more in construction costs because of bad trade deals that politically happen. I mean, so many things can happen. You know, the city's denying different permits. Who knows? It's not leasing up because someone built right next to us and they're leasing up before us, and therefore we can't collect enough, you know, tenants. There's a lot of things that can happen with that. So now my principal, my initial $500,000 is at risk. I've had no house money in the meantime. I haven't been able to reduce any risk. And now I'm looking at a loss of potential principal. So just think of this idea of, again, the 2 things that professional investors know: continuously moving over into new investments. So as cash flows rolling in, you're making new investments using that cash flow. And that's how you create exponential wealth. You keep stockpiling on to the cash flow. A big way that Robert Kiyosaki, Rich Dad Poor Dad author, invests is he calls it the infinite return. So he'll go in, add some value to a property, do a refinance, pull a lot of that initial equity out and go do another deal, and then add value and refinance and pull as much equity out as he can. He'll go do another deal. Well, meanwhile, he's holding all of these properties and they're all still cash flowing. So this is the exponential growth curve that he's creating that way. So there's different methods to it. I honestly don't prefer that method, believe it or not. I like the shorter sale points. I like to sell between 3 and 5 years potentially and move it into more investments myself. But hey, it doesn't matter, me versus anybody else. Just wanted to paint the picture of what this is all about. So that's really what the blog's about.
Yeah, I mean, there's a lot of people that I've talked to on the podcast that started off with a chunk of money. Usually it's not 500 grand. It's a lot less than that.
Sure.
And they're active investors, obviously. And, but the same concept applies where they'll use that 30 grand and then they will kind of follow the Robert Kiyosaki strategy. Well, they'll buy a property. It's called a BRRRR strategy.
Yeah.
They'll buy it, they'll rehab it, they'll rent it, they'll refinance, and they'll repeat it. And whenever and on the after that first investment, that repeat, you're now using, that same money again. So you're kind of like, you've got a house and you've got your 30 grand back. And so,
Yep.
the only difference now is I have a house, plus I've got 30 grand to do it again. And so they continuously use the same money over and over and over again to build up a portfolio, while at the same time generating cash flow from those properties that they can then use that house money to go ahead and continuously reinvest. And as I mentioned on our conversation, I think it was last week when I talked about this, because like I remember I made this spreadsheet where I compared 401k versus investing, and I remember I did it, and I realized that, well, the 401k, I can keep putting money in here like over and over and over and over again, whereas in this scenario, I'm putting in $50,000 or whatever it was, and then that's it. I'm not investing again. And so not only is the value of that of not only is my net worth way higher in this investing category, but the amount of money I'm inputting is also different. So the ROI is just massively different because of the fact that again, I don't need to keep putting money into a 401k. I can just reuse that same capital over and over and over again, while at the same time generating house money.
Exactly. So the lesson is, when you reinvest cash flow, you're essentially reducing your risk. I mean, at the end of the day, as you said, really at the end of the day, this is a very simple concept, but wanted to go in because, and I'm sure anybody who's on, professionally on LinkedIn, or I think it's Instagram, those are probably the two worst for being hit up by these Bitcoin and cryptocurrency traders who call themselves investors. And it just drives me nuts. I just can't. And so this is kind of, maybe that's where I derive this deep in my subconscious. I'm angry. But anyway, I just wanted to get the reality out there that, that is not investing. If there's no cash flow to it, if it's speculating, which of course crypto is speculating, you're not an investor. You can call yourself that. And that's the problem, though, is a lot of people like to call themselves investors. So anyway, that's my rant on it.
Bitcoin's the future, Travis. You didn't know that? That's the future.
Well, it may be, but it's still, we have to acknowledge that it's a speculative play, and that if we're going to buy Bitcoin at 10,000, the hope is it's going to go to 20, right? That's the hope. That's the speculation. If we buy at 10 and we sit on it for 20 years and it goes to 5, right? I mean, that's the whole concept there. So Benjamin Graham has a great quote I'll close with here on this concept. He says, confusing speculation with investment is always a mistake. And hey, sums it up. Couldn't be more true.
Yep. Yeah. In our Three Immutable Laws post, we talk about it similar to gambling scenario that, you're playing blackjack or whatever. And I think we talk about roulette, and you bet on black and it happens to hit black 10 times in a row. And you look like a genius because, you've 10 times your money, and then you put it all on black, and then it lands on green, and then it's all gone. And you're like, oh, what happened? This is, there's no, again, it's not, there's obviously not, at least I don't know of skill in roulette. There's still some skill to this. So it's not exactly like gambling, but it's much closer. Speculating is much closer to gambling than what we talked about as investing. So is there anything else you want to mention before we sign off?
Just one more quick concept. I'm sure a lot of people who are stock investors or have heard the term the lost decade in the stock market. It was just that had you bought in at a particular time in the last decade or 20 years ago, actually, and then held stocks long term, we went from basically the peak of the market to financial collapse. There would have been a 0% return in a full decade. Well, had you been invested in cash flowing anything that provide interest, dividend, or cash flow like real estate, you at least would have had that, and over the course of a decade, you could have potentially doubled your money. Who knows? And so that's the whole thing, is I never want to place a bunch of capital in something, wait 15 years to find out if it's going to pan out. To me, it gets back to the 401k thing we talked about earlier. But Anyway, I could go on and on, but no, I don't have anything else. We'll cut it off.
Perfect. All right, Travis. Well, make sure you check out his blog post, "How to Invest Like a Pro: Speculating versus Investing." I'm assuming it's in Bigger Pockets. It might be on joefairless.com too.
Yep.
And Travis, thanks again for joining me. Best of listeners, as always. Thank you for listening. Have a best ever day, and we'll talk to you tomorrow.
Thanks, Theo. Thanks, everybody. See you later.